All right, let's dive into one of the most powerful tools in a trader's toolkit, the Fibonacci retracement. You know that feeling when you see a great trend, but you have no idea when to jump in? Well, if you've ever been stuck wondering that, then you are in exactly the right place. Let's get into it. So, here's our game plan. We're going to start with a problem every trader faces. Then, I'll introduce you to your new favorite tool. We'll cover exactly how to plot the levels, the crucial step of waiting for confirmation, and how to find something called confluence. And we'll wrap it all up with 4 key takeaways you can start using today. Okay, first things first. Let's talk about a challenge that trips up even the pros, the pullback problem. Look, we all know you don't want to be the person who buys at the very top of a trend. That's a recipe for disaster. The smart money waits for a pullback, for the price to take a little breather. But here's the million-dollar question. How do you know when that breather is over and the trend is ready to take off again? Now, sometimes this is easy, right? The price pulls back to a super obvious support level from the past. Simple. But what about when it pulls back into, well, what looks like empty space? There are no obvious clues, no previous levels to lean on. That's the hard part. That's where traders get nervous, and that is exactly the problem we're here to solve. So, how in the world do we navigate those pullbacks that seem to happen in the middle of nowhere? Well, it's time to introduce you to a very, very cool tool that can help. Meet the Fibonacci retracement tool. At its core, its job is to help you spot these potential turning points during a pullback. It does this by creating key price levels based on a pretty fascinating mathematical sequence. So, check this out. Remember that tricky chart from before? Watch what happens when we apply the Fibonacci tool. Bam! It instantly generates these hidden levels of support. Suddenly, that scary empty space isn't so empty anymore. It's filled with potential reversal zones that traders all over the world are watching. Okay, now that you've seen what this thing can do, let's get down to brass tacks. I'm going to show you exactly how to plot these levels on your own charts. It's really just a simple 3-step process. First, you've got to find a clear, obvious trend. Second, you pinpoint the very start and the very end of that move. We call those the swing low and the swing high. And finally, you just connect those 2 dots using the tool. That's it. Now, the direction you draw in is absolutely critical. For an uptrend, you start at the bottom, the swing low, and you draw up to the top, the swing high. For a downtrend, you guessed it, it's the complete opposite. You go from the top down to the bottom. And hey, here's a little pro tip for you. Always, always connect the very tips of the wicks, not just the candle bodies. You want to capture the absolute full range of the price move. So, drawing the tool, that's the easy part. The real skill, the art of it, is learning how to read these levels and having the patience to wait for the market to tell you what it's going to do next. Once those levels are on your chart, there's a particular area that gets a ton of attention from traders. It's got a cool name too, the golden zone. So this golden zone is made up of 3 specific levels, the 38.2%, the 50%, and the 61.8%. And believe me, these aren't just random numbers. They represent really important psychological points where a pullback often runs out of steam and the original trend is ready to kick back in. So you really want to keep a close eye on this area. And then there's the 100% level. Think of this as your line in the sand. This is your point of invalidation. If price breaks past this level, your whole idea of a simple pullback is off the table. It's not a pullback anymore. It could be a full-blown trend reversal. Now, if you remember only one thing from this whole explainer, let it be this. These levels are not automatic buy or sell buttons. I'll say it again. Just because the price touches a Fibonacci level does not mean you immediately jump into a trade. You have to be patient. You have to wait for more clues. So what does this confirmation actually look like? Well, let's build a case. First, you see the price come down and actually react at a key level, like the 61.8. It stalls there. Then, maybe you see a strong bullish candle form, like an engulfing pattern, showing that buyers are fighting back. And for the final piece of the puzzle, the price breaks above a small nearby resistance level. See? When you get multiple signals like this all lining up, your odds of a successful trade go way, way up. All right, ready to level up a bit? Let's talk about an advanced technique that can seriously boost your confidence in a setup. It's called finding confluence. Confluence is just a fancy word for when different technical reasons to take a trade all pile up in the same spot. It's kind of like having several different road signs all pointing in the same direction. It creates a zone that is much, much stronger than any single indicator on its own. Think about it this way. A 50% Fibonacci level by itself, that's pretty interesting. But what if that same 50% level also lines up perfectly with a major support or resistance level from last week? Now that is a high probability confluence zone. It means multiple groups of traders are all watching that exact same price, which makes a reaction there much more likely.
Whew, we have covered a lot. So let's take a moment and boil everything down into 4 simple, powerful rules you can take with you.
Okay, here it is, your Fibonacci rulebook. Number 1, treat these levels as zones or areas, not as razor-thin exact lines. 2, make sure you know what the bigger, long-term trend is first. 3, I'm going to say it one more time, always wait for price action to confirm your idea. And 4, stack the odds in your favor by looking for confluence with other support and resistance levels. You know, with this tool in hand, those confusing pullbacks that used to seem so random now have structure. Those hidden levels, well, they aren't hidden from you anymore. So go on, pull up a chart. What will you discover?